Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives at Schwab, and this is Investing in Dividend Stocks. And today we're going to be talking about diversification. And specifically, we're going to discuss how an income investor might quickly identify what they consider to be strong dividend stocks in a specific sector. We're going to be going through example priorities of that sort of an investor, and then constructing an example scan, finally adding an example position to our paper money portfolio. So a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody that's already chatting in out on YouTube. Hello there, JV Texan and Mighty Mouse, Lawrence, Mighty Quinn, Dave, Will, Life in the Fast Lane. Let's see, who else is here? Rojo and Eva and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. If you'd like to be here, this is a Thursday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Brent Moores is going to be hanging out in the chats out there on YouTube. He's going to be watching for any questions that arise from our audience. And if I can't get to those questions, Brent's just there to help me pick up the slack a bit. So thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening, whether live or on the recording, to follow your favorite Schwab presenters on social media. You can find Brent and me on X. You can find Brent there at Brent Moores CS. You can find me on X at Cameron May CS. You can also find and follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion of diversification among different sectors and how we might find dividend stocks showing apparent strength in a specific sector. And as we do, of course, we need to first pause to consider the risks associated with investing. So bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. The very first thing that we're going to do is a quick portfolio check-in. See how things are coming along. We'll highlight some of the criteria for investment that we've discussed in the construction of this portfolio. Then we're going to take a look at current market conditions and see what's going on from an income investor perspective. Kind of an interesting day again out there in the marketplace, but we're going to use that as a backdrop to add some additional diversification to our portfolio. So as we're doing that portfolio review, we're going to be looking for gaps in diversification, and then we're going to look to fill those gaps using the tools on Thinkorswim. So specifically, we're going to be going through our list of example priorities for dividend investment, and then loading those priorities into a custom scan that we will direct to a specific sector to try to find a new dividend stock for that portfolio. So that's what we're going to be doing today. Let's go right to the Thinkorswim platform, and we're going to start with, let's go to our monitor tab. Here are our 10 positions. So we're basically about 10 weeks into 2026. I launched this series right at the start of the year, and we've been acquiring these stocks one at a time each week. Now, we all know how 2026 has gone. It hasn't been a good one so far, a good year for stock investors, but for maybe income investors, for dividend investors, it hasn't been so bad. So here's where we stand now. We have 7 of the 11 sectors represented in our portfolio. So diversification has been a point of emphasis. Not every investor manages their portfolio in the way that we do in this series, but in this series, we will be emphasizing diversification. So one sector that I note doesn't have a presence here, but also tends to historically contain a number of stocks that pay comparatively high dividends, is industrials. So we have staples, we have utilities, we have healthcare, energy, real estate, materials, and financials, but no industrials. So I'm actually going to put a pin on that, and that's going to be a point of emphasis as we try to further diversify this portfolio. We're going to be looking in that industrial sector for potential dividend investment candidates. Now, we also note our ex-dividend date here, so our would-be investor can see when they might need to purchase stocks by in order to participate in future dividends. Here's our dividend frequency yield across our 10 securities. I think we're just about 3.5%. That's roughly triple the 1.15% that's being paid by an average dividend-paying S&P component company. Our beta is a measure of volatility, and with the exception of Target, the other 9 stocks here have lower than average volatility. A beta score of 1 would indicate kind of average volatility as benchmarked against the S&P 500. So lower volatility, higher yield across a range of sectors have all been priorities here. Barbara says, do you think each sector needs to be represented in this kind of portfolio? It's a really good question there, Barbara. And for some investors, they might say no. There may be some sectors that may be, let's say, traditionally more volatile than they're comfortable with, or maybe they just don't pay dividends, or maybe they think that the position within, I don't know, maybe they follow the economic cycle model closely. Maybe they think it's just the wrong time. Now, for other dividend investors, though, they may not really care where we are in an economic cycle, and they prefer to just spread their investments across a range. So when some sectors are doing well, others might be a little bit struggling, but those that are doing well may be picking up the slack. When the markets rotate away from favorable stock conditions, there may be some sectors that hold up better than others. So it may be that they prefer that diversification for those purposes. But again, some might actually be okay with greater areas of or greater degrees of concentration in specific sectors for whatever motivations. All right. Dividend payout ratio is something that we've kept an eye on. There is one here. You'll notice that O, which is it's a REIT, required to pay a higher dividend. It's kind of stretched things this most recent dividend. That may be an exaggeration of where it is typically, but other than that, our dividend payout ratio, we've tried to keep that under 1. Long-term debt can be seen by some income investors as a threat to the company's ongoing ability to continue paying those dividends. So we're trying to keep our long-term debt, let's say, under 50% of total capitalization. And then beyond that, we can just look at how things have been going for these stocks so far this year. Think about how 2026 has gone. It's a down year for most stock portfolios, but for ours, we're actually up about 4%. KMI has been doing a lot of the heavy lifting, but actually, it's not been too bad across a number of our stocks. So far, so good. I do want to talk about what the market conditions have been for a dividend investor, though. So let's go have a look. Let's go look at the charts. First thing that we typically look at is what's going on with bond yields. Because for dividend investors, they may see bond investments as kind of competition. So if bond yields are spiking, as they have been over this last month, it may attract investor attention away from dividend stocks. It can have a little bit of a suppressive effect on dividend stocks. And actually, that's what we've seen recently. But bond yields have been increasing, probably, yes, because of what's going on in Iran. Unfortunately, we know that oil prices have been going up. The price of stuff has been going up. The threat of inflation seems to be peaking again. And that may, to some investors, mean that there's a decreased likelihood of a Fed rate cut, and that's kind of pushing these bond yields higher. So if bond yields are comparatively stronger than they have been, maybe dividend stocks have been a little bit less appealing. So let's switch over here to our index that we follow, the Dividend Monarchs Index. So if you're not familiar with this is a chart of a group of stocks known as the Dividend Monarchs. There are companies that have been paying dividends for at least 50 years. They're also required to be S&P 1500 component companies. And so for some dividend investors, they'll look at the performance of this index of stocks as indicative of what maybe an average dividend investor might be going through. And it's been a good run for quite a while for dividend investors as measured by this index. But you can see right here, as the yields have been going up, just as we might expect, dividend stocks in general have been coming down. Now, in our portfolio, we've kind of defied that trend to some extent. So that's nice. However, we're getting a little bounce here. So that might provide some sort of a backdrop for the sort of market conditions we're in right now as we select a new dividend stock for our portfolio. But one takeaway for a would-be dividend investor here is maybe we're buying at dips. That's a possibility. Melissa says, is there a general rule for how much of your portfolio should be dedicated to dividend investing? That always goes right to, there's not a general rule of thumb because, boy, we're all different human beings with very different risk tolerances, very different return objectives, very different goals for what our portfolio is going to do for us. So it has to be tailored to the individual. So no, there's not. Okay, good question though, Melissa. Anyway, let's go find a dividend stock. All right, we're going to be adding to our example portfolio. Just because we're apparently at a dip doesn't mean we can't go lower. But what that might mean, as we've discussed in recent weeks, is that yields might be a little bit better than they were just a few weeks ago. So let's go have a look. And I'm going to be looking at a specific sector for a couple of reasons. We are going to be looking at the industrials sector because, first of all, we don't own anything in the industrial sector. Second of all, if we look at that sector, let's come over here and we can actually load up a Thinkorswim public watch list, the S&P 500 sector indices. Those are the 11 sectors right here. And if we look at the industrial sector, it's been kind of an interesting story for industrials for the start of 2026. From the middle of 2025 until the end of the year, you can see this sector really didn't do much. It was really underperforming most other sectors. However, another little bit more subtle trend maybe was underway if we go back to the first week of November and going on through really the present day, including this pullback that a lot of sectors have seen. Overall, we've been seeing some strength that we haven't seen for quite some time. So if a dividend investor is out there looking for strength, that might be here with the short-term exception of this possible dip. So let's use those two reasons. Obviously, none of this adds up to a guarantee that industrials is the place to be right now. Pardon me. But for a combination of factors, let's say that our dividend investor would like to see dividend stock added to their portfolio from this sector, right? Melissa, yeah, you've been trying your hand at trend trading. It's not been pretty this year. I would suspect not, because the trends have just not been good. They've been hard to find. Yep. Anyway, before we go put together a scan, because I kind of already have. As a matter of fact, I'm just going to go show it to you. You guys are already familiar with this if you've been watching my series at all. In a previous webcast, we constructed a scan. I'm going to load it up here. We're going to load the dividend working class scan, but you'll see just above that, I have a dividend sector scan that I'm going to be showing you how I built that using the dividend working class. So this is that scan. And these are the example priorities that it's attempting to address. Number one, obviously, is yield. But number two is diversification. Number three, consistency. We can confirm by looking at a chart after running this scan. Debt, volatility, and performance. There we go. So those have been our example priorities for the kinds of dividend stocks that we look for in this series. Yield is the whole point. Diversification may be a way for an investor to potentially spread risk out, reduce risk. It still exists, but it's an attempt to mitigate that. Consistency of dividends is a common priority among dividend investors because it's nice if a company just started paying a dividend, but they could discontinue it very easily. If instead we see a company that's been paying dividends consistently over a number of years or decades, maybe the investor might feel a little bit more confident that they're going to continue collecting those dividends in the future. Debt can be a threat to that ongoing payment process. So debt is a point of emphasis here. The volatility of the stock, for some, they prefer to not be on a roller coaster ride in market values as they're just waiting from quarter to quarter or from month to month for their dividends to be paid. So we do typically look for lower volatility. And total performance, including what the price of the stock does, has been a point of emphasis here. So how does this scan address those? All right. Well, the first thing that we're doing is we're scanning in the S&P 500. We're looking at great big companies. Big companies theoretically may have a greater financial foundation from which to continue paying dividends that possibly they've been paying for a long time. Diversification is going to be the point of this search. So how about we do that right now? So the first thing that I've done, we've already selected to scan in. Let's see, that would be in the public watch list right here, the S&P 500. But we're going to intersect that with a specific industry or sector. Now we can go we can get all the way to industry granularity levels. I'm just going to go with sector levels. So let's come over here and we're going to add the industrial sector and just scan. We're going to select all industrials to conduct this scan. Now, I'm also going to remove this. Let me clear that filter. We previously excluded the dividend aristocrats because we already had positions in the dividend aristocrats, and what we were attempting to do was to scan the S&P 500 for other companies outside the dividend aristocrats. But here, let's just say we're okay. If that aristocrat is in the right sector and has the correct criteria that meet our priorities, we're not going to exclude those. Wacky Wack says you're going to catch up on all this stuff over the weekend. The great thing is this session is being recorded. Brings up a good point. If you're watching this webcast for the very first time, don't feel the pressure that you have to catch every single click and every single comment that I make. Instead, these webcasts are recorded and they're posted to our YouTube channel after the webcast is concluded. The vast majority of our webcasts are added to our YouTube channel. So make sure, if you haven't done it already, that you subscribe to the channel. Just pop down below the video stream, click on the subscribe button. It doesn't cost anything to do that. It literally only takes a second. But this allows you, our channel, it's called Trader Talks Schwab Coaching Webcasts. And that channel allows you to join the live streams, of course, but also you can find the playlists for previous webcasts. So as was just stated there, sometimes you want to catch up over the weekend when you can digest things a little bit better. So then you can just go to the playlists and you can find this webcast series. Now this one happens to be right at the top of all of our webcast series. So I can click on View Full Playlist, and there is last week's discussion. Why high dividend yield can be a trap. We talked about 2 different traps that dividend investors might want to keep an eye out for. All right, but let's go back to our scan and let's see. Melissa says, can we have the scan link shared if it won't throw off your momentum? Absolutely, Melissa. Yep, let me do this. I'm going to share this scan right now, but I'm also going to show how you can build it for yourself. Let me quickly grab a link here, and I will paste that into the chat window for our live audience. And for those of you that are watching on the recording, what you can do is just go down in the description under the video, and I'll just have a link right there for you. And when I share a link, here's what you do with it. Don't go put it in your browser URL bar. It's not going to work. Instead, even though it looks like, it says http:/, looks like a typical URL. Nope. Instead, we come into Thinkorswim. We go up here to this gear icon, and we're going to open the shared item right there. You just plop that in here, click Preview, and then Import. And what that does is it adds it to your Thinkorswim platform. So if you were to then go up and load your scans, it will show up in your personal scans right there. And I've titled it Dividend Sector Scan. If it asks you to give it a title, you can call it whatever you want. All right. There you go. But let's look at the rest of this scan. So first thing, yield. We're trying to address this yield priority. We've set that between 2% on the low end and 6% on the high end. Low yields, not the purpose of our discussion. High yields, for some, as we discussed just last week, it was the topic of conversation. They may be a trap. So maybe go check out that if you missed that. Market capitalization may help with consistency. So we're looking for $10 billion companies or larger. If you don't know how to add these, you can just select from the menu here. We've selected yield. We've selected market cap. We've selected beta, which is a gauge of volatility. A beta score of around 1, think of that as sort of average volatility. That's kind of a simplification of what it really means, but I think that's serviceable. Beta score of 1 is average, above 1 is above average, below 1 is below average. And so for some investors who prefer their volatility of their stock to not get too out of control, at least not to be too historically high, maybe they'll look for half of average to 1.5 times average. So that's going to be our beta score. Now I've also added here a debt requirement. I did that. So this is long-term debt to capital. That can be added as a fundamental filter. So if I were adding it brand new, I'd choose fundamental filter, and I can choose long-term debt to capital right here. And then we can just add the requirement, which I've set at a maximum of 50. So to explain that, what we're doing is looking at the total capitalization of the company. That's basically all of its assets, including like and I should say it's financial assets, such as debt, yes, common stock, preferred stock. We add all that up, and then we divide the long-term debt by that number. All right. So it just tells us how much of the capitalization is just coming from debt. If we have a very low number, it means most of their capitalization is coming from stock. If we have a very high number, it means they're really heavily financing things through debt. So for a dividend investor who's trying to keep that debt representation fairly low, maybe we'll set a cap of 50% of that market capitalization. So we have yield, we have diversification addressed by scanning in a specific sector. Consistency, we'll check on a chart. There's an assumption of consistency when we're buying a stock that's an S&P 500 component company, but it's not a guarantee by any stretch. Debt, we've specifically addressed here. Volatility, we've specifically addressed here. And performance is another thing that we're going to check on a chart. So there's my scan. So once we built a scan, what we can do is come right up here and we can save that scan. So if you're building it at home and you don't have to rebuild it every single time, well, you can just follow along as I've done here and then click Save Scan Query and then give it whatever name you want. You know, maybe you call it the sector scan. So I'm just going to click Save. And if I were to now, let's just wipe this one off the screen. Let's just hit Reset. It's gone. And if we were off on some other portion of Thinkorswim and we come back to the scan, we could now load that scan right here, our personal scans. There's our sector scan. It loads everything back up the way we had it constructed, and we can run that scan. Another nice thing about a scan, once we've constructed it, when we've saved it, it'll also create a watch list. So if we were to come over here to our watch list and we go to our personal watch list, you'll see that there's one that's called sector. If I were to click on that, there are the 5 companies from the industrial sector that meet all of our criteria. So as we look down here, we have Stanley, we have Snap-on, we have Automatic Data, we have Fastenal, and we have Broadridge. What we know about all 5 of those companies is that they're meeting our criteria up here. And I want to focus on just these first couple. All right. So let's add one of these to our example portfolio. But it looks like the top two yields, and by the way, if I click on this column here, I can orient those according to their yield. Especially, this is particularly helpful if there's a bunch of companies. Right now, there's only 5. But I can see that the top two are Stanley and Snap-on. And for those of you who really enjoy tinkering in the shop, you recognize these are a couple of tool makers. There's actually a lot of overlap between these two companies. So maybe they're very similar. How might we choose between the two? Well, right now, who do you think might have the upper hand at the moment? Yeah, Barbara says, why did you choose those two? So Barbara, basically, they're the two highest yielding in this sector. But I want to do a little bit deeper comparison than just that, all right? So one of them pays in March, one of them pays in February. One of them has a little bit longer term debt than the other. I will say that in the industrial sector, they tend to carry relatively higher degrees of debt, although with these companies, we've capped it at 50%. All of them meet that requirement, and they're actually not particularly strong levels of debt, although Stanley seems to have quite a bit more than Snap-on. Now, there's another thing. Yeah, Melissa, exactly. That's why we're talking about these two. I also thought it would be interesting to compare two companies that are very similar in the product lines that they deliver. So for those of you who aren't familiar with Stanley or Snap-on, if you were to go to your local hardware store, you would see a lot of their products lining the shelves. Stanley and Snap-on both make a lot of those hand tools, a lot of those power tools. I would say Snap-on tends to be more of the commercial or the professional grade. Stanley tends to be more of the retail grade. Although if you've heard of, like, let's say DeWalt, Stanley makes DeWalt. Snap-on makes Snap-on. Snap-on tools, very expensive. In any case, but Stanley's paying the higher yield. Maybe our investors tilting that direction. But Newman's dad says, can you add the frequency of the dividend payout? You can. And I do have that displayed here on our monitor tab. We can see the dividend frequency. But on our scan, if you want to add a column that's not already here, let's see, what exactly is the title? It's just div freq. So we'll look for that here in our customized column set. Let's type in div, and let's see if that's a choice here. I don't know if it is. Maybe it's not one of the columns that's available on the scan. That's okay. Oh, no, there it is. There it is. There it is. Let's add it. If that's helpful to you, let's pop that up there. We'll put it up maybe next to dividend yield, dividend date, dividend frequency. There we go. Maybe it might. No, I don't have to reposition much other than to be able to see what this Q means. But that's our dividend frequency. All right, so if there's anything else that the investor needs to see, they might want to just add a custom column so they can do a little side-by-side comparison. In any case, there are two of our priorities that we haven't yet confirmed. We have consistency, and then we have performance. So let's go to the charts where we might address both of those. And I'm going to type in, let's look at maybe Stanley first. There we go. So SWK, and I'm going to go to a long-term chart. Let's switch this to a 10-year chart. And what we can do is just a quick spot check. These green icons down at the bottom allow us to see dividends that have been paid. So if I go back 10 years ago, I can see the dividend then was 55 cents. If I go forward a year, it's 58 cents. If I go forward a year, it's 63 cents. And then 66 cents, and then 69 cents. I think we're seeing a pattern here. 70, 79, 80, 81, and 82. So this is a company that's not only paying its dividend consistently, but has been increasing that dividend over time. So far, so good, right? What's been going on with our friend Snap-on? Snap-on, also a highly consistent company with a 71-cent dividend, 82 cents. That's an earnings announcement. Let me hover over dividends. 95, 108. Let's skip out here. You get the point. $2.14 dividend. Now, there are a couple of things that I might want to note here as the would-be dividend investor. Number one is that Snap-on is increasing its dividend while its price has been going up. What that's doing is it's keeping that yield probably relatively consistent from year to year. On the other hand, we have Stanley, which has been working hard to increase its dividend, but its price has been suffering. It's quite likely that the price has been suffering for so long, over a 10-year stretch, because its profitability has likely been suffering. And so if we're trying to squeeze a consistent dividend out of inconsistent profitability, that may be a trap. That's what we talked about last week. All right. It's not guaranteed. It's actually not even something I checked before launching this webcast, but it is a suspicion that I have at this point. But there's another thing. So actually consistency, it's kind of a check for both. There's no tiebreaker there. The tiebreaker might lie right here, performance, right? And you might have already seen this. How has price done for both companies? Price for Snap-on has generally been rising for a 10-year stretch. Price for Stanley has been coming down. But actually, when I talk about performance here for a dividend investor, they may look at performance as a combination of price plus dividends. Even if a company isn't doing a lot, if it's paying a big fat dividend, it may still be worth it. So here's how we can show a chart that will reflect both of those. I'm going to go up here to our little gear icon. I'm going to go to equities because we're talking about equities or stocks. And I'm going to select right here where it says adjust for dividends. Instead of just making a chart adjustment for a special or unusual dividend, I'm going to change this to all. And as I click apply, if you're not familiar with what that feature is, what that does is it reconfigures the chart so it now shows a net total performance of dividends plus price. So here's Snap-on. Basically, it's gone from a net value of $100 per share. Once we layer in price plus dividends, that thing has more than tripled. About 3.75, 3.6%, 3.6 times, not percent, 3.6 times the value from 10 years ago. If we compare that to Stanley, even throwing the dividends in, they haven't compensated. Oops, not what I intended to do. Even dividends have not been able to prop up price. Now, price has been up and down, but this is maybe the kind of roller coaster ride that a longer term dividend investor might not be looking for. But what I can say, bottom line, is that this has not been a productive stock for even if we're taking those dividends, reinvesting them into the company, it hasn't been productive. So for that reason, how about we go with Snap-on for today's addition to our portfolio? Now, just because it's been the better stock over the last 10 years is not a guarantee it's going to be the better one over the next 10 years. Dave says, can you show a chart of the dividend payout amount? Let me see if I can do that, Dave. I've never done that before. But if we go up to edit studies, I don't know if there's going to be anything along those lines. I don't think so. If someone's aware of a study or a tool, or because Thinkorswim, I don't ever like saying Thinkorswim can't. Because how many times have you said that? It's too bad Thinkorswim can't do this. And then with a little bit of digging, you discover, oh, wait a minute. My fault. Thinkorswim can do that. So even having been using this platform for more than a decade, and even as the guy who actually teaches the platform, there are still little nuggets that I discover from time to time. Anyway, Melissa says, is there a time when you would get out, like if it falls below the 200 moving average or something? Some investors might. Melissa, we're not going to in this webcast series. So as I go add this to our portfolio, we'll talk about when we might choose to get out of some or all of a position, okay? Let's go to our trade tab. We're going to type in Snap-on, SNA, and clicking on the ask price. This is a $300 stock, and what we've been doing, we have a hypothetical $200,000 portfolio, and we've been assigning 5% of that portfolio to each of our purchases. So that's going to be what, roughly, I'm guessing 25 shares, something like, no, 27 shares. Let's see. Let's get our calculator out. 10,000 divided by 362-ish dollars per share. 27. Let's call it 28. There we go. So we're going to buy 28 shares. I'm going to enter this as a market order. Now, when we enter a market price, we are taking a risk. Price right now is $362.26, but we'll just pay whatever the market requires at the time. There's a risk at that. We might get the price at a lower, we might get filled at a lower price, it might be a higher price. But I'm just going to click confirm and send. Buying 28 shares of Snap-on at the market price. No commission on this investment. There can be on some types of trades. Let's send that order off, but you can see this is going to be right around a $10,000 purchase. I'm going to send that order off, and we just bought those shares. So now that we're in, and we've discussed when we might exit, but I haven't covered that in really good detail recently. I did do a video. Let me go back here. This is our list. 7 potential reasons to sell a dividend stock. And also we discussed some reasons not to sell. It actually wound up being, I think, 4 reasons to sell and 3 reasons to not sell, for a total of 7. So what are some reasons that we might sell? None of those reasons are going to be because price drops, or because a headline creates some fear, or there's a chart signal. Nope. None of that for this webcast series. There are a few reasons. Number one being, let me go back to our portfolio here, rebalancing. As an example, well, when we bought KMI, we invested 5%, and we're trying to be diversified with our portfolio here. We don't want, we're just putting ourselves in the shoes of that hypothetical investor who doesn't want one stock dictating how their portfolio does. So we're trying to keep the stocks sort of in alignment with one another. So if one of our stocks starts to grow really big, we're going to trim it back. That's one reason we might sell. If another stock actually loses value, believe it or not, unless things have changed, if it's taken on a ton of debt, if it doesn't qualify anymore, we may not add to it, but otherwise we'll add to it rather than exiting. So rebalancing is one thing. Another thing that might cause us to shed the stock is rising price. Now that might sound like the same thing. The stock's gotten larger than the rest of the companies. Well, sometimes a lot of the companies drop in value while while one stock just sort of holds on to its value. And that can still make it be disproportionately large. So rebalancing might be because of price. We just have an explicit rule within our portfolio to monitor price. Okay, so if price rises, we may trim that down if that's requiring us to rebalance. If the company cuts a dividend, it's no longer serving its purpose, we're going to sell it. And finally, if the company performs a reverse split, its price hasn't probably just gone down, it's probably gone down to an extent where the companies having to employ artificial means to prop up value, probably going to sell in that case. All right. Melissa says at some point you'd lose money if the price starts to collapse. Absolutely right. Yep. What we're just going to prepare for is hopefully not everything collapses all at once. That's always a possibility. But if one of our stocks starts to fall, that may actually drive the yield up. And as long as it continues paying a dividend, we're going to add to that position. But I know that feels a little bit weird, especially if one has been learning all about trading, which is very commonly strongly tied to price performance and to chart signals. And then we try to shift back into sort of investing mode. It can feel unnatural. I get that. But yeah, we're investing in this webcast series, not trading. All right, so Mad Notes, good to have you here. You're a little tardy is a quick way to know if a stock pays a dividend. Absolutely. Yep, just bring it up on a chart and look down here at the bottom for these green icons. If you see the green icon, it's a dividend payer. If there are no green icons, it's either not a dividend payer or you don't have that tool turned on the chart. So one thing to check, let me go back here to our 1-year chart. Actually, let me make a quick change. Let me switch this back so that we're not showing not reflecting dividends and price anymore. I'm going to switch that back to just special. But as I go back to the 1-year chart, there are our dividends. You can see not only is it paying, but you can also see the size of the dividend. If that's not showing, just make sure that in your chart settings that you show corporate actions. So where it's when you go to equities, show corporate actions. A corporate action is something that can influence the stock price. So basically stock splits or dividends, things like that. All right. And then you'll see these icons down at the bottom. Guys, I've accomplished what we set out to do today. I wanted to talk about diversification and how that might be supported by the tools on Thinkorswim. So we built a scan that can help us search for stocks that meet an investor's dividend investing priorities. And we can target that to a specific sector. So hope you enjoy that scan. We'll continue to build out this portfolio. Watch, we're going to monitor for things that might cause us to sell positions, but I actually don't anticipate selling anything anytime soon. Although KMI, it's growing. Right now it's up 24%. If that gets closer to 60% growth, what that will probably have KMI doing is it's probably going to be about like 8% of our portfolio, and that's the threshold that I've set. If a company gets to be more than 8% of the total portfolio size, I'm going to trim that thing down. But we'll watch for that. All right. Hey, Mad Notes, you're certainly welcome. Everybody, time for me to let you go. Go enjoy the rest of our educational offerings. We have a few more webcasts coming up today. We have webcasts all throughout the week. But as you do go, just remember to take advantage of the full slate of educational offerings available to you from Schwab Education, starting with our YouTube channel. So if you haven't subscribed to the channel yet, do that right now. You can go down, click on the subscribe button. As I said before, it only takes a second. It doesn't cost anything. And the YouTube channel is where you can join these live streams if you want to chat as we're talking, or you can just go to the playlists and watch the archives on demand. Now, another thing that Brent and I would definitely suggest you do is to follow your favorite Schwab presenters on social media. You can find Brent and me on X. You can find Brent on X at Brent Moores CS is his handle, and you can find me on X. Here's my handle, at Cameron May CS. I'm very active on X, and if you reply to one of my posts, I just reply right back to you. I don't know an exact percentage, but I would say I reply to probably better than 95% of comments on my X page. There are a few times I decide not to because, you know, sometimes people say wild things and I don't want to engage in that, or it's just a little bit too sensitive, right? But in any case, very active on X. You can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. And if you reply to my post there, I'll try to reply there as well. But guys, go enjoy the rest of your day. Thanks for giving me your time and attention. Thanks for all the thumbs up. I saw that about 108 people still watching, and there are 58. That's more than half. That's awesome. Thank you. If you enjoy one of our webcasts, click the thumbs up. It's always appreciated. It only takes a second, but it's like a pat on the back to your presenter, and it also gives us a nice boost in the YouTube algorithm so that our video gets seen by more people. All right, everybody. I will look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But until I see you again, I want to wish you the very best of luck. Happy investing. Bye-bye.